Hello, good afternoon, and welcome back to our episode and to our Modesty's Morning Masterclass. Another beautiful Monday here, and we're here once again to do what we do every Monday. Ooh. So, as you can see, I'm fresh back from the seaside. I took a break with the family and it was lovely. And those of you who are conversant with what's going on my Facebook page, you could see the picture splashed all over my Facebook page. I had one heck of a lovely time. And nothing beats a time with the family, and we just had some wonderful memories I will cherish for the rest of our lives. It's good to take a break, and as you can see, don't I look fresh? Of course I do. If you don't tell me, I see myself, and I know I can tell myself. So thank you so much for all your messages of support. Thank you so much for your messages of encouragement. Thank you so much for all the positive messages we've been receiving on Facebook, and thank you so much for understanding, the need for me to take that break. So I wasn't here with you last Monday, so it wasn't easy for me because every Monday, really, I look forward to coming to speak to you, my fans, my friends, my audience, because I have this special connection with you, and it makes me look forward to Mondays. So today I couldn't wait for the day to break, really, for me to come and do this, because this is already part of me. It's already part of my schedule. It's already part of my daily routine. So any Monday I don't do it, I just feel like there's something missing, because we have that telepathic connection or relationship already with my audience. So thank you so much for bearing with me for not being here on Monday. But hey, I'm here now, and we can crack on. We can start from where we stopped, and we can continue our financial romance here, basically. Okay, so how has it been? I hope you've all had a very good break as well. Look, August is a month of break, and throughout the summer, just pick out a time, take a break, recharge, refresh, and be refocused, and then come back stronger. I mean, the body needs, it's a machine, so sometimes machines need to be looked after. So look after your body and take enough rest and take enough break when you have to and when you need to. And to be honest with you, these things don't have to be expensive. You can always do what your budgets can carry. But whatever you are comfortable with, just take a break. Take time off work. Take your brain, take your mind off work for a while, and then you can use that time to reflect, to repurpose, and to re-energize yourself, and then you come back stronger and fresher. I am a living witness to that. So it's done me a world of good, and it's given me this renewed sense of purpose and mission and vision to go out there and do and do more. So today we're going to continue where we stopped before. I rudely interrupted myself with the break, and then we were on a series of essentials of family finance, and I promised I was going to bring those the episodes or the sessions in this series one after the other, because I didn't want to jam pack them into one show and then just give it bits and bits and there are no details. So I want to pick out one single item on a family finance and treat it and do justice to it. And that's what I've been doing for the past 4 weeks. So this is session 4 on that series. And today we're going to be talking about a very, very vital part of family finance. And that vital part we're going to be talking about today is insurance. Okay, insurance is a very, very important part of family finance. Whenever you are drawing your family financial plan and insurance and protection is not part of it, it is absolutely incomplete, right? But before I go into that, I have chosen to be doing something recently just to give this show some kind of a refreshed look, right? Every week I'm going to be giving you the positive vibe of the week, because I just want everybody to know and understand that on this show and on this program, on this platform, only positive vibes are tolerated. We've got no time for negativity. We've got no time for negative vibes. If you've got bitterness and negativity and doubts and fears and things that will pull us back, keep it to yourself on this show. What we want here are things that can make us progress, things that can help us move forward, and things that will engineer and generate positivity among everyone. So there are a few people who have been appreciating the things that we do, and I just feel like I have not been doing them the justice that they deserve by bringing the positivity that they have been bringing to this show onto this show. So I've chosen to be starting the show with positive vibe of the week. Sometimes it could be a quote on positivity. Sometimes it could just be a review or a feedback that we've got that is positive on any of our social media platforms, whether it's on LinkedIn, on Facebook, on Twitter, on WhatsApp, wherever you have given us a positive vibe. I want to be picking out those positive vibes and I want to bring in them to the show, just to let people know that it doesn't take you anything to be positive about something. And the more positive you are about about things, the more positive results you tend to achieve and come across in life. So positive vibe of the week today, I'm going to be reading from a Facebook feedback that I heard from one of our ardent listeners and somebody who's been religiously following this program, and he just wanted to express his appreciation for what we do and how it has helped him and what he thinks about it, which is what we always encourage here. We need your feedback. We want to know what you think. We want to know how you feel. We want to know whether what we've been doing here has had any positive impact on you at all. And if it has, it doesn't take you anything to just express it, by way of comments, by way of likes, by way of feedback. And now I want to be bringing it onto the show. I won't bring every single one of it, at one time, but one at a time. I will be pulling them from wherever I can pull them. I'll bring them onto the show. So our positive vibe of the week is coming from one of our listeners called Gabriel Kazim Olayinka Owosheni, who wrote on Facebook, and this was what he said. He said, "You've done well for many people, especially myself. You deserve your time off, bro. Thank you for everything. I mean everything." And he typed that everything in capital letters with 3 solid exclamation marks. So I could feel the positivity oozing out of this guy about what we do, and his sense of appreciation for what we do. And Gabriel, I want to say very massive thank you to you for leaving us that feedback. He was responding to my message anyway when I said sorry I wasn't going to be there last week because I have taken some time off to recharge and come back stronger. And he just felt like expressing himself and giving us that feedback. And that's why he said you've done very well for many people, especially myself. You deserve your time off. Thank you for everything. I mean everything. That's what Gabriel Kazim Olayinka Owosheni said to us. So thank you very much, Gabriel, and we very much appreciate it. And this sort of positivity is what keeps us going. So we want more of that, and as you give it to us, we'll give it back to you here on this platform. So let's talk about insurance as part of the essentials of family finance. Right. So you see, insurance or protection, whatever word you prefer to use, they're all the same thing. It's simply a mechanism that you've put in place for events that you do not know when they are going to occur. And the funny thing about insurance is that when you need it, you can no longer arrange it. So you can only arrange it when you don't need it. Okay? So, and there is what we normally say about insurance is, if you cannot afford to lose it, protect it. If you cannot afford to lose it, protect it. So insurance is a form of protection for things that you know you cannot afford to lose. For example, people insure their cars because they know they cannot afford to lose that car. It's very vital for them to move around. It's very vital for them to fend for their family and to earn a living. People cannot afford to lose their houses to fire. So they insure their house against fire, against any kind of, destructive element to the house. Some people cannot afford to lose their phones. So they insure their phones just in case they lose them. Some cannot afford to lose their laptops. They insure them because they cannot afford to. So if you cannot afford to lose it, protect it. But we don't want to be talking about material things and tangible things that you can protect. Those are obvious. We are talking more about life. But then you can then say, wow, well, if you lose your life, then that's it. What are you protecting? So what you're actually protecting when you take a life insurance is you're protecting your peace of mind and you're protecting the comfort of your family. And those two things are things you need to ask yourself, can I afford to lose them? Can I afford to lose my peace of mind? Can I afford to lose the comfort of my family and the confidence of your family as well? Knowing fully well that your family is well protected, the peace of mind is priceless. You cannot put a price to that. The comfort of your family is priceless, knowing that you have provided for them no matter what the situation brings. It is priceless. Okay, so people will start to ask, so when is it basically advisable for me to start, arranging protection or arranging insurance? Basically, preferably before starting a family. Some people think that they are too young to arrange insurance. No, before you start a family, in fact, as long as you have a job and you have dependents, or you have loved ones around you, you can start arranging a life insurance for yourself, because at that stage and at that time it's a lot cheaper for you. So preferably before you start having a family, before you get married, it's get life insurance. It will be very, very cheap for you then to protect it, or get income protection. If you have a job, even if you're not married, protect your income, because even without the family, you still need the income. But the focus of this session is on family finance. So we want to focus on, insurance around the family life and around the family line. Okay, so, but certainly and definitely, the moment you get married, for God's sake, don't go and bring somebody's daughter out of their parents' house and expose them to unnecessary risk. The moment you get married, all the love you are professing to your wife or to your fiancé before you got married to her, the practical expression of that love lies in how much you want to protect her against unforeseen circumstances. For example, on the news recently, there's a police guy, a UK policeman, who died 4 weeks after his wedding. PC Harper. This guy died in the line of duty while he was trying to recover a stolen vehicle. The guys who stole the vehicle dragged him along the road and he died in very horrible circumstances. Now he's got a widow who lost her husband just 4 weeks after their wedding. That is horrible. That's heart-wrenching. That's heartbreaking. But consider a situation where there is no protection, no life insurance in place, even in the course of that marriage. What happens? Just like that. Assuming they are, before they got married, they were partners and they bought a house together, and the mortgage of that house still has to be paid, and bills still have to be paid, and that lady will still have to deal with the loss, painful loss of her husband, and the financial worries as well. Yes, she may have family support around, but for how long will the family support hang around her? For how long will it be? Or she might remarry. But that's an instance that getting married today, anything can happen at any time. So this is a real life story I'm telling you, that 4 weeks after wedding, this policeman died in very tragic circumstances and leaving behind a widow, just 4 weeks. So immediately you get married, all that I love you, I miss you, I cherish you, you are this, whatever it is you've been telling her that's been spinning her, the moment you bring somebody's daughter into your household, get a life insurance and protect your family from then on. Yeah? So preferably before you get married, but definitely once you're married, get life insurance. Now, a common question that has also been popping up every now and then is, what sort of life insurance is best for the family, especially for married couples? Do we do a joint life insurance, or should we just do our individual life insurance policies? Now, if you had a life insurance before you got married, the moment the both of you get married, you both have to individually review your individual life covers and align them with your family financial goals. So the moment you get married, you become one flesh, one body, you become one. So your family financial goals should be one goal. But your individual life insurance policies can still remain individual as they are, but the goals that they seek to achieve has to be the same thing, right? So you have to review your individual life, because before you got married, the circumstances were different. The moment you get married, things change. You know, the lady would have changed her name to your surname, so there will be need to review the name on the policy. You know, you would have had a different scenario to marriage as well. So you have to align, both of you will have to review your individual life policies and align them with your family financial goals. If you are taking on a joint life cover, the things you need to consider is, would that joint life cover be on first death or on second death? Now, joint life first death is a joint life insurance policy that pays out upon first death. It means the two of you, whoever dies first, if one party dies first, the life insurance company pays out the claim. If it's a joint life second death, if the first partner dies, the policy doesn't pay out until the second partner dies, which means maybe it's just arranged for the children. Maybe you feel your partner can still hang on without you. It doesn't need the claim, just keep the policy on, because it might be difficult for him or her to arrange another policy when you are no longer there. So just keep the policy alive, keep it as second death. When the both of you dies, then the policy pays out to whoever the beneficiaries are. That's joint life second death. But most policies are arranged on joint life first death, because in most cases the surviving partner would want to make a claim and needs the proceeds of that insurance to carry on with life and to cope with life, no matter how difficult and how hard it might be. So, joint or individual life. Now I'm going to give you the pros and cons of these two types of life insurance policies that couples can arrange, and then we can discuss around those pros and cons. Pros and cons basically simply means benefits and advantages and disadvantages, or positives and negatives around those. So each of these policies have their own negatives and their own positive side. Now, joint life, let's look at the pros first. What are the advantages first, or the positive things that are going for joint life? Number one is that if you guys have a joint life policy, it's one premium that you pay. So the two lives brought together, it's only one premium that is payable, and it's easy to manage. Because if you need any issues around that, or any changes or any adjustments you need to make, it's just one change, one adjustment, and the whole thing is fixed, because it's joint life. So both lives are joined together and they are protected together. So it's easy to manage. And then there's one provider. So if, for example, your insurance provider is Royal London, for example, so it is one provider, Royal London, covering both lives. So you don't have to deal with multiple providers. You don't have to deal with multiple policies. It's one provider dealing with that life insurance, and both of you are under that umbrella of cover. Then it's also one sum assured, right? So if the sum assured is £200,000, the sum assured basically means the value of the policy. What is the policy worth? For how much are you insured? So if the sum assured is £200,000, for example, it is £200,000 for both lives. It's not split between two people, and not one. Nobody's wondering how much is this one worth and how much is that one worth. Okay, and then it's cheaper. It's cheaper than individual policies, because when you bring those both lives together, you pay less than what you would have paid if you had those lives insured separately. Okay, so those are the pros of joint life policies. What about the cons? What about, some of the negative things that you might encounter, or some of the challenges that come with it? Number one is it gives you less household sum assured. You remember we talked about the sum assured, yeah, in the pros. It's one sum assured. But if you compare that to individual life policies, in that household, individually, it gives you a less sum assured than if you had individual life policies that are brought together. All right. So if one life policy is worth 150,000, this one is worth 150,000. The household sum assured becomes 300,000 if you bring them together. But then if you have sum assured of 150,000 pounds for both of you, it means you have just like half of the sum assured that both of you had individually, because it's joint life. You now arrange both sum assured and it becomes half of it. So it gives you less sum assured based on the premium. So you can see that on the same premium, you will not get the same amount of sum assured. You get less on that sum assured. Now, the other one is that the surviving partner loses the cover when claims happen, right? So if it's a first life, if it's a joint life first death, once a claim happens, the surviving partner will lose the insurance cover. That nullifies the insurance cover. It doesn't, so they are not covered anymore the moment they make a claim, right? So it's one of those things that affects joint life policies, because once one partner dies and the claim is made, it nullifies the policy, and it leaves the surviving partner without any cover, unless they go to arrange cover for themselves differently after the claim. Number three is what I've said, right? The claim nullifies all policies. The policy is cancelled once a claim is made, compared to compared to individual life covers. If one claim happens on one life, it doesn't affect the other claim. It doesn't affect the other policy. Okay. Number four is that there is difficulty in arranging fresh cover for the surviving partner, depending on what stage of the relationship that claim happens, or depending on what stage of the marriage or the relationship that the claim happens. If it happens at a very later stage of that policy, you find out that the surviving partner will be maybe too old for the insurance company to accept them, for another life cover, and they won't be able to get the same amount of life cover that they had, which they lost because of the claim. So if, for example, the policy is a 32-year policy, for example, and the claim happens in the 25th year of that policy, so it means that they are at least 25 years older than they were when they took out the policy. Assuming the surviving partner was 33 when they took out the policy, it means that at the time the claim happened, they would have been 58. And obviously, at the age of 58, you will struggle to get a cheap life policy that will give you the same amount of cover going forward. But if they had individual policies, 25 years down the line, this person's policy remains valid. Even if there is a claim, it doesn't affect the other person's policy. So it will be a little bit difficult in arranging cover for the surviving partner. Apart from the age issue, or depending on when it happens, the fact that a claim has been made, it will affect, the assessment and the viability of the cover that you want to pick up next time, because the insurance company will be seeing it as a high risk. And when they see it as high risk, it will be difficult for them to arrange a cover for you based on their assessment of risk. So they will see you as being of a high risk, right? So it will be difficult a little bit for them to arrange a cover for you, or for you to be able to assess the right amount of cover. Now, let's talk about individual life. Assuming the policy is not a joint policy, assuming it's an individual policy that both of you arrange for yourselves, what are the pros of arranging the life cover individually? Number one, on the pros, like that's the advantages or the positives, is number one is that one claim doesn't nullify all protections, which is what we mentioned in the joint life pros. So if you are arranging the policies separately and one party dies and there's a claim, because the two policies are standing independent of each other, it doesn't nullify all the policies. This person's policy still stands and the surviving partners still have their policy and they can still carry on. Number two is that the partner can move on with their protection intact. So the surviving partner can move on with their lives with their protection intact. They don't have to worry about anything about nullification of their policies or cancellation of their policies, because they were arranged on individual basis. And then number three is that there is more sum assured in the household. So if you arrange, instead of having £150,000 joint life policy, if you choose to have £150,000 policies individually, it means in that household, under that same roof, there is an aggregate of £300,000 worth of life insurance, okay, rather than having £150,000 life cover. Number four is that in the event of relationship breakdown, it does not interrupt the protection provision. So if things don't go well in the marriage or in the relationship and they decide to go their separate ways, they can go their separate ways with their individual policies intact. It doesn't nullify anything, it doesn't change anything, it doesn't disrupt the policy provision. So every one of them can walk away with their individual policies. They can then decide to make individual adjustments to those policies just to suit their new lifestyle or their new status. Okay, now number five is that the full advantage of individual attributes can be taken if the policies are taken out individually. It means that the individuals in that particular household can take full advantage of their individual attributes while arranging that policy. Take for instance, if one partner is older than the other, the younger partner can take advantage of their young age, and arrange and get more sum assured, even at the same amount of premium. So the same amount of premium will buy the other partner a bigger sum assured, a bigger amount of insurance cover than it will buy the older partner. But if they were together, they cannot take advantage of that individual attribute that this other partner had, because the insurance company will be looking at both of them from the prism of the older partner, and the older partner will be the basis of their risk assessment when they are assessing the risk. But when you separate it, if one partner has an age advantage, they can take advantage of that. And some other things that affect life policies are the kind of job you do, your sex in terms of your gender, your age, right? So if you can take advantage of the age, the sex, the gender, and the type of work you do, if you can separate both and take advantage of each of those attributes, maybe one partner is doing a more tedious and riskier job than the other, so their premium might be a little bit higher for the amount of cover that they want. And if this other partner is doing a less riskier job, it means they can arrange more cover for themselves than the other partner. So when you bring those covers together, they have more in the household than they would have had if they came together and did it on a joint basis. Number six is that the cover is designed to suit individual and collective family needs. So as an individual, you can design the cover to suit your individual needs and align it with the family objectives as well, because the cover is individually designed for you as a person, even though it's in the interest of the family. So it's the cover, the protection is designed and has individuality on its own, but then it's aligned to the family's financial objective. And then number seven, if that policy is put in trust, right, it can be used to protect specific loved ones. So you can basically use that policy to protect specific loved ones. For example, there are certain broken relationships where this person will say, I never want, I don't want my children to suffer in the hands of a strange person, you know, should I not be there? Maybe if I am there and my wife decides to remarry or my husband decides to remarry, I don't know what's going to happen to my children under the roof of somebody else. So in the event of that happening, I'm going to put this policy into trust, and I would specifically direct the trustees that in distributing the proceeds from this policy, I want the proceeds to go specifically to this person, to this person, to this person. Okay? So meaning that if there is anybody you do not want to benefit from the proceeds of that, if you want you to protect specifically your children, maybe against maybe maltreatment or harsh treatment from some other person you don't know, or you don't want your children to be subject to somebody else's whims and caprices and you don't know who the person is, you can just use the policy to do that. Because it's an individual policy, you can decide what the trustees do with that if you put that policy into trust. Okay, so those are the pros for individual life. What are the cons if you arrange them individually? Number one is that they are more expensive than joints, even though they are insignificantly more expensive. When I say more expensive, it doesn't mean that, you know, the premium will be double what the joint one is. No, from experience, the increments, the incremental premium on top of that is really something that you can afford to make compared to the double or more than double amount of sum assured is going to give to you. Say, for example, you both decide to have a £200,000 policy each. The younger partner in that relationship will have £200,000 policy at a cheaper price because of age, right? And if other factors fall in line, and this person has a £200,000, you know, policy. If you bring those two premiums together and compare it to what the premium is for the both of them to have £200,000 policy in one policy, the difference is really very insignificant, and it's something that you can afford to really say, for double the amount of cover, I am happy to do that. But the fact remains that it is more expensive than joint policies. Yeah. Number two is that it could be different providers, which makes it a little bit difficult to manage. So say one partner's policy might be provided by Zurich and this one might be provided by Royal London. So it means that you have two different providers you are dealing with as far as the family policy is concerned. But then that's something that you have to deal with, because maybe in the while we were searching and recommending, we found Zurich to be more appropriate for this person and Royal London to be more appropriate for this person, and then we recommend each, you know, different providers for each person in the household. So it could be different providers, and that makes it a little bit more difficult to manage because there are two different distinct companies that you have to deal with at the same time. And then the policy could become too individual, and then there's a possibility that you could lose sight of the family financial goals. There is the risk of the individuals in that arrangement to become too individual with their policies, that they will now start focusing more on what they want and what they want to achieve, and making it, designing to be too individual, and they will lose sight of the family financial goals. It's a risk that's there if it's not well managed in the household. Number four is that affordability could hamper the continuity of the coverage. Assuming the dead partner was the one paying the premium for both policies. There are families like that where one partner who is more financially well off is the one paying for both policies. Okay, so if death occurs in the household and that dead partner happened to be the one who was paying for both policies, and that one is the dead one, it might leave the surviving partner exposed and unable to afford the policy, and you know, he or she might just cancel the policy because they cannot afford it, because it's a joint, because it's an individual policy and was paid for by the more financially well-to-do partner. So that's also a risk. Okay, so those are the pros and cons of individual life arrangements in the family, and pros and cons of the joint family protection arrangements. Okay, please, if you have any questions to what I'm saying, feel free to type out your questions in the comment section, and I can attend to those questions. But I really want you to pay attention to it, because this is really important for you as a family. If you do not have your protection or your insurance arrangements in the family, your financial arrangements are grossly inadequate and grossly incomplete. Okay, now the family protection policies that you need to consider in the family. First of all is what we call the level term assurance, which is what we commonly call in the insurance terrain the death policy. So it's just the level term assurance is a normal life insurance policy that pays out upon death only. Okay, it doesn't pay out no matter how much you've paid into the insurance pot. The only time it pays out is upon death. So if during the period of that insurance nothing happens to you, and that insurance runs out and runs its course through that period, nothing happens to you, you don't get anything. So this is not an investment, it's not a savings. There is no cash-in value for this one. It's pure death cover. Yeah, that's why it's called, it's a level term assurance. It's a normal life insurance policy that's very, very cheap to arrange, because basically the risk is just they pay out upon death. Then the second one you need to consider is the critical illness cover. Now, I find it difficult to arrange life cover for someone without a critical illness element to it, because the truth of the matter is that in the family, right, once you have a family, you consider it's a fact that you are more likely to suffer a critical illness than you are to die. Critical illnesses like cancer, like stroke, like heart attack, like diabetes, and heart surgery, things like you are more likely to come up against in life than die. And critical illness covers are more expensive than life cover, because the risk is more likely to happen, and that's why it's more expensive, because it's riskier. But then if you have just life cover and you don't have critical illness cover, it doesn't work, to be honest with you, because if anything happens to you health-wise, or any of these critical illnesses come up against you, what is your family going to do? The bill still needs to be paid, the mortgages needs to be paid, the financial commitments you have still have to carry on, and then your family will have to deal with your illness and then with the financial worries all at the same time. Consider the burden of pain that will bring upon your family. So if you have just life insurance cover and you have no critical illness cover, you need to quickly go and address that. All right, and that's whenever we arrange life insurance cover for our clients, we always make sure that they take critical illness cover. And you can vary your critical illness elements to your life cover elements. They may not have to be the same thing, because it's more expensive. So you can have a certain level of life cover and a lower level of critical illness, depending on what you can afford. And then depending on what you want it to do. If you want your critical illness to be able to pay off your mortgage in the event of critical illness, because what critical illness does is that when you are sick, when any of these critical illnesses happen to you and you are diagnosed of any of them, your doctor and the insurance doctor they both agree that you have this critical illness, maybe cancer or stroke or heart attack or anything. The insurance company pays you out the value of that critical illness cover in lump sum while you are still alive, while you are still suffering from that illness. It doesn't wait until you're dead. So that will help you sort out things like medical bills, put your house in order, sort out financial situations and commitments, pay off mortgages, just make life a little bit more comfortable for you while you're still ill. Because certain critical illnesses can change your life, significantly. You might even need to remodel your home to suit you, because it might even affect your mobility. So you might need to fit in some things in your house that will help you to live your life more comfortably. And those things cost money. But if you have critical illness cover, the money you get from the critical illness cover claim can take care of all that. Okay? The other thing you have to consider is private health insurance. Yeah? So if you have private health insurance, it means you have access to medical care that is not common, especially in a country like this where there is we have the NHS, but there are certain treatments that the NHS don't offer. So you have to look for private hospitals that offer that treatment, and then you have to pay for it. But if you don't have private health insurance and you have those health needs, you will not be able to take care of them. I mean, it's more common in US, in America, if you don't have your health insurance, you can't have health care. But, here it's more of a luxury maybe for some people. But sometimes when you find yourself in a situation where maybe you are even abroad, some health insurance policies can take care of your healthcare treatment while you are abroad. The other thing you have to consider is decreasing term assurance. This is mostly useful for people who have mortgages to pay. It means that if you take out a sum assured, as time goes by, as the amount attached to that insurance reduces, the sum assured reduces, but your premium remains the same. So if you have a mortgage of £200,000 and you take a decreasing term assurance, so as the amount of that mortgage reduces, your sum assured for that policy reduces, which means at every stage, if any claim happens, you will only receive payout to the equivalent of the value of that amount that was attached to that policy initially. So if you've paid down your mortgage to, say, £150,000, and at that stage something happens to you, maybe critical illness or death, the insurance policy will pay out £150,000 to pay off that mortgage or to pay off that whole debt. So as that debt reduces, the sum assured reduces, but your premium will remain level. So, but this premium is usually cheaper than the normal, life insurance cover because of that decreasing term element of it. The other one you have to consider is family income benefit. Family income benefit is an alternative to life insurance. In this case, instead of the beneficiary being paid out in lump sum, you will arrange a certain amount that you think and you believe your family will need to survive on every month, and they'll be receiving that payment in that order and in that frequency until that sum assured is exhausted or until that policy runs its course. So that's an alternative to life insurance cover. So the only difference is that family income benefit is a life insurance on its own, but it pays out in bits rather than in lump sum. So if you don't want your family to be paid out in lump sum, but for them to be taken care of on monthly or quarterly basis, family income benefit might best suit what you want to do. Or if you want them to be paid out in lump sum, just take out a normal life insurance and then that's it. The other one is income protection. Income protection, if you have a family, make adequate arrangement for income protection because you don't know what's going to happen to your job. There are certain elements of income protection that has unemployment cover to it, but most of them has accident and sickness cover to it. So it means that if you're unable to earn due to accident or sickness, the policy kicks in and starts paying you a certain percentage of your normal income, usually up to 70% of your normal income, until you're able to get back to work, and then that payment stops. It doesn't nullify the policy can still carry on going. So family income protection is a very, very important one. If you have a job and you have an income, seriously consider having income protection, because you don't know when sickness or accident will happen, and it will affect your ability to earn. It will put your family in a serious financial risk, because it then means that there is no way money is coming in, and then what happens? The bills still have to be paid, the mortgage still have to be paid. It could lead to you losing your home or even losing your marriage sometimes if the other partner can no longer bear the whole pain. So you seriously consider protecting your income against such risks as accident and sickness by taking on income protection. These things are not too difficult and they're not too expensive to arrange, but they are really, really vital. And what income protection, you have to choose your deferment period, because if you want the payment to kick in immediately that risk occurs, the premium will be more expensive. If you want to defer it to about 4 weeks or 12 weeks or 26 weeks after the risk occurred, the longer the deferment period, the cheaper the premium. Okay? But hey, don't look at the premium, just look at the necessity. If you think you have savings that can last you up to 6 months, and in the event of accident or sickness, you won't need that policy to kick in after before 6 months. You can defer it to say 26 weeks. Say, please don't pay me anything until after 6 months. If I'm unable to get back to work after 6 months, then start paying me. Your premium reduces. If you choose 12 weeks deferment, it reduces your premium. 4 weeks deferment, it increases your premium. So the longer the deferment period in income protection, the cheaper your premium is. Now, I want to quickly run through some misconceptions that people have about family protection, about insurance. Number one is that some people think that faith is an alternative to insurance because of certain beliefs that they have in their faith, maybe as a Christian or as a Muslim, whatever faith you practice, you think that that is an alternative to arranging insurance. I've spoken to people who have told me, somebody who has a family and he's telling me, look, I'm a Christian, I'm covered by the blood of Jesus, I'm not going to die, death is not my portion. And for goodness sake, get real. Okay? Even bishops do die in motor accidents. Even reverends do die in plane crash. People of different faiths, when accidents happen, they don't care what faith you are. Your faith should not detach you from reality. Get real. This is, we're talking about protection. We're talking about getting ready for eventualities, for when they occur. All right, so faith is not an alternative to insurance. The reason these things exist is to help our lives make it a lot easier. Because when that accident or that death occurs, your people of faith will gather and they will console your family for just a while, and they will all disappear. And then your family will be left to deal with the pain that you have put them through. Number two misconception I want to address is that insurance companies are not trustworthy. Some people have told me, insurance companies, these guys are crooks, these guys are criminals, you can't trust them. Yes, I will not say and stand here and pretend that all insurance companies are saints. There are certain insurance companies that have bad record when it comes to claim settlements. But that's why you need an advisor. That's why you need somebody to hold your hands when you are doing this. That's why you don't just pay attention to whoever gives you the cheapest policy to take, and then you get what you pay for. Okay? So if somebody guides you and says, look, I recommend this to you on my professional advice. If you want to follow my professional advice, do this. Seek for professional advice. Go through a broker who understands the whole of the market, who is not just aligned to one provider and all that. Go through a broker who is very objective, who can advise you on that and recommend a policy for you. Go through all your circumstances and tell you that this is what I think will serve you best. It minimizes the risk of you having this misconception about insurance companies being trustworthy. Secondly, when you are asked to disclose certain information, do not try to play intelligent one. Do not try to play games or play smart with insurance companies, because it will come home to bite you when you want to make a claim. Disclosure is disclosure. If you don't disclose what you need to disclose, when you come to make a claim and the insurance companies find out things at the later stage of that claim, they will decline the claim. And then you start screaming that they are crooks, they don't pay out. But you are the one who was trying to be a crook at first. Okay? Number three is that people are saying that claims aren't paid, that they don't pay claims. Insurance companies do pay claims, especially in this country. There are insurance companies who have very, very good records on claims settlement, but they don't pay stupid claims. They pay claims that are justified, and as long as your claims are justified, they pay, because they are regulated businesses. If they don't pay out claims and you have a serious case against them, if they don't resolve it, go to the financial ombudsman and make a claim, because they are regulated businesses, regulated by the Financial Conduct Authority. So you have a channel through which you can channel your grievances and get justice if you feel you've been undone. So do not believe in that misconception, oh, these guys don't pay claims, let me not waste my money. No. Number 4 I want to deal with here is that people say that insurance is a luxury, that is not a necessity. Come on. If you can insure your car, insure your house, insure your phone, insure your gadgets, how much more your own life, right? The life that actually earns the money that pays for those things. It's not a luxury, it's a necessity. When you're building your family budget, make sure you have made provisions for premiums for your life insurance. When you're budgeting how much you want to be saving every month, make sure that your insurance premium is part of your budget every single month. It's a necessity. As you're paying your council tax, so you should be paying your life insurance. Yeah, you shouldn't treat it as just a luxury, because what people do is that once they start experiencing some kind of financial difficulty, the first tap they turn off is their life insurance. They go and they cancel it and say, no, this one is not a necessity, so we can do without it. Sorry, you are increasing the risk that is applicable to you. The other misconception is that some people say, oh, I'm too young to get covered. The younger you are, the better for you to get covered, because that is when your premium will reduce. That's when you get the cheapest insurance cover for the most amount of cover, because your age is a significant factor in deciding how much cover you get and how much of a risk you are to the insurance company. So if you think you are too young to get covered, you're deceiving yourself, because that's the opportunity you are throwing away. So the younger you are, the better for you, and the better policy, the higher sum assured you can get, and the cheaper your premiums can be. The other misconception I want to deal with here is that people say that insurance is too expensive. Insurance is not too expensive. But if you think it's too expensive, try not getting insured. And then when the risk occurs, you understand what expensive means. It's more expensive not to get insured than to get insured. Trust me. Take, for example, if you don't have vehicle breakdown cover in this country, in this UK, and vehicle breakdown cover might cost you like 55 or 60 pounds a year, 55 pounds a year to get a vehicle breakdown cover, which means that when your car breaks down on the road, you just ring AA or Green Flag or RAC and tell them where your car is broken down, and they will send one of their engineers down there. If they cannot fix that car on that roadside, they will now tow the car to the nearest garage or mechanic where you can fix your car and get on your journey. There are some of them that are even extended to the point that they can come to your house and fix it at your doorstep. If it breaks down, it's refused to start your house, it might cost you that 55, 60 pounds to get that arranged. And to you, that might also be expensive. But then when your car breaks down on the road, try calling a recovery vehicle to come and recover that car from the road. That's when you know the definition of expensive. Okay, I remember when I didn't have a breakdown cover, and my car broke down. That was years ago anyway. My car broke down and I was just stranded. I didn't know what to do. I had to look for the nearest recovery vehicle to come and get my car off the road. Trust me, I paid through my nose just to get my car recovered from that spot to the nearest garage where it should be fixed. It was damn too expensive, and that's when I realized what the meaning of expensive is. And from that day on, I just put breakdown cover on my car every year, because I would rather pay that 60 pounds or 55 pounds or 50 pounds or whatever to the car breakdown cover company and have my peace of mind, and then I can drive to anywhere I want to drive to, because if breakdown happens, I know I am covered. So it's more expensive not to get covered than to get covered. Okay, now the final thing I want to talk about here is reasons people don't get insured. I mean, this list, these things I'm talking about, they are not exhaustive. There are many more things that I could add, but I just picked some key things that I wanted to share with you. Reasons people don't get insured. Number one is procrastination. People don't get around to do things that they need to do when they need to do it. And they just say, oh, I'll get around doing it, I'll do it. And then time keeps going. You do it, you keep procrastinating. Do it right now. Immediately after listening to this program, go and get life cover. If you want me to help you, give me a call, get in touch with me. I can help you get a proper life cover for you and your family. Faith, number 2 is faith and religious misconceptions. Okay, I've mentioned it before. People misconstrue their faith and their religion to be in antagonism to life insurance. No, it should be complementary to each other. Okay, your faith, keep your faith and keep going, doing what you're doing. But hey, do not get it mixed up with life insurance and treat life insurance like it's from pit of hell or it's like a devilish concept. No, it is something that was meant to help human beings, mankind, that you are taking part in a pool of funds where risks don't occur all at the same time. So when your risk occurs, somebody else's money is used to pay your claim. And if somebody else's risk occurs, they use your money to pay somebody else's claim, because everybody is in that pool, and everybody in that pool cannot die at the same time. It's a simple concept that is not difficult to understand. Number 3 is affordability. Some people think they cannot afford, life insurance, but you cannot believe how cheap life insurance is. A £200,000 life cover could cost just about £10 a month to get £10 a month is like £2.50 a week. A cup of coffee here costs about £2.49, depending on the size you want to. So that's like the cost of one cup of coffee a week. Set aside to just arrange life cover for yourself. You cannot imagine how cheap it is to get life cover. And then if you can afford to now get more cover around yourself, critical illness, income protection, why not do it? Because you are doing it for the love of your family. The other one is lack of faith in insurance companies. Reasons why people don't insure. That's what I'm telling you here. People don't have faith in insurance companies. Unfortunately, there are some bad eggs in the insurance industry. But do not, because of those bad eggs, deny yourself and your family the protection that you require. Because there are far more better and good ones than the bad ones. But unfortunately, bad news spreads faster than the good ones. So people only talk about bad experiences. They don't talk about the good experiences. But there are more claims paid out than claims that are not paid out. And that's a fact. So do not say that insurance companies, you don't have faith in them, you don't want to have anything to do with them. You are doing yourself more disservice than you are doing to the insurance companies, because these companies are already rich, they're established, and even if you don't insure with them, millions of people are insuring with them, and they are doing their business. So you're not actually hurting them, you are hurting yourself. The other reason people don't insure is because of misplaced priority. People prefer to go and buy expensive clothes and shoes and live life and go to club and buy cars, buy gadgets and do other things than spend that money on insurance. The money they spend on drinking and smoking alone every month can buy them a lot of cover in insurance. Misplaced priority. The money you spend on eating and dining and whining and frivolous lives can actually get you a decent life cover. So arrange your priorities in a better order, and you will see that insurance will rank very highly on that list. That's if you love your family enough. Anyway, the other one is lack of education. And that's why I'm doing what I'm doing here. Some people don't understand why they should get life insurance. So you are getting this education now. Lack of education should no longer be an excuse why you shouldn't get life insurance, why you shouldn't get yourself covered. Because you have no excuse, if you're watching me, if you're listening to me, to say you don't know enough about life insurance. If you still want to know more, get in touch with me. I am very happy to talk you through the process. I'm very happy to recommend to you. I'm very happy to advise you on that. The lack of education should not be an excuse. The internet is everywhere. Go on the internet and make your own research, and get yourself educated and get your family covered. The last and final reason is irresponsibility. And it's as blunt as a truth as I can tell it. I can't paint it any better. All right? Irresponsibility. If you have not arranged a life cover for your family, you are irresponsible. I don't know how else to put it, because it is the height of irresponsibility to think that you can control things that you cannot control. These risks are out of your control. The only thing you can control is the amount of cover you can get to cover your family against that risk. So control what you can control first of all, and leave the things you cannot control for whenever they occur. Then you have put things in place to take care of those unforeseen circumstances. It's highly irresponsible of any family to live their lives as if everything is normal without any form of cover. And always review that cover at all times to make sure that it's equal to what you want them to achieve. Okay, so folks, thank you very much for being here with me once again today. Sorry for taking so much of your time, but this is something that I'm very passionate about, and I want to spread this news, and I want you to help me spread this news. Share this video as widely as possible as you can, especially among our African and Black communities. We are very, very complacent when it comes to life cover, life insurance, and all these things. And that's why I want to educate us. That's why I want us to understand how important and why we need to do this. Because a lot of the times we victimize ourselves and we cry the victims. In this case, you are not a victim unless you decide to victimize yourself. So get yourself and your family protected, and God bless you as you do that, and stay blessed. Have a wonderful week ahead, and hey, I'll see you again on Wednesday when we come for our Modesty's Mortgage Masterclass. And next week, Monday again, I'm going to come back to you with another session on essentials of family finance. Until then, stay blessed and stay safe. Bye now.